Hello and a very warm welcome to Econoday Unplugged on Wednesday, the 30th of August 2023. Terry Sheehan's on the East Coast and I'm Jeremy Hawkins in London. Late last week, Federal Reserve Chairman Jerome Powell and European Central Bank President Christine Lagarde once again stressed their determination to get inflation back on track, leaving investors all the more concerned about a possible fresh round of interest rate hikes next month. Well, with both central banks keen to toe the data dependency line, what happens then will, in no small way, be determined by this week's look ahead at some key economic data for August, notably Eurozone's flash inflation report on Thursday, and I guess it really goes without saying, Friday's US employment report update. So in today's podcast, we'll have a quick look at what's expected and what the implications might be for the economies and central bank policies. Right, let's get stuck in straight away then. Terry, what's expected in Friday's data and what elements of the survey do you think the Fed will be looking at most closely?
Well, let's see now. There's a lot going into this report on Friday, and there are a number of special factors we have to keep in mind.
Okay.
However, the bottom line is that we are expecting to see slowing growth in employment, probably somewhere in the 150 to 175 range. But we're not expecting to see unemployment change much. So we had our JOLTS report, the report on job opening and labor turnover yesterday, and it showed a significant decrease in the number of jobs open and also some slowing hiring. But that was back for July. So we're going to see the August data on Friday.
Can I quickly interrupt you on that? What is the kind of a correlation between the JOLTS data and the upcoming, as you say, for the next month, the subsequent payroll data?
Well, what we saw in the JOLTS data was that although there are fewer job openings and hiring is down a little bit, the number of people losing their jobs hasn't changed. So what we're seeing is what some people call a Goldilocks moment for the Federal Reserve, in that businesses are not cutting workers, or at least not significantly right now. So if they're not hiring, they're not laying off, which means a relatively stable job market at the moment.
It's interesting, but similar sort of picture we've had in Europe for quite a long while. I mean, clearly growth across the Eurozone and indeed the UK has been significantly slower than you've had on your side of the pond. But even so, businesses have been very reluctant to actually cut labour on the grounds that the labour market's still so tight. And I guess that's kind of pretty exactly what you're saying your side.
Yes.
Let me ask you, you mentioned the ADP report. Can I just quickly about wages? I don't know how much attention people actually pay to the ADP survey with regards to wages, but that suggested, if I recall rightly, the slowest growth in wages since October 2021. Do you think that will have any bearing upon the wage components of what we see on Friday?
Well, I don't know that there's a direct correlation. ADP specifically says that they're not supposed to be used as a way to estimate what the government report will do. But there clearly is a slowing trend for wage growth. So we may not get a strong increase in wages in the August data, but at least on a year-over-year basis, they should be still growing at least somewhat above the pace of inflation.
And what do you think is more important for the Fed now? I mean, clearly, I guess bottom line to all these central banks is what's going on with inflation. So I mean, is it wages that usurps, if you like, the payroll, even the unemployment rate now, or do you simply have to mix it all together and come out with some kind of hopefully logical conclusion?
Well, I think as Fed policymakers always try to say, they have a whole range of data that they look at. It isn't any one component, but how they try and achieve an overall picture of the labor market.
All right, if I was on just in terms of inflation, talk a bit about wages. We had the revised GDP numbers out a short while ago from your side, and just looking quickly superficial at it, as far as I was concerned, some of the inflation components really seem to be pretty good, and in particular, the price index for gross domestic purchases, that was just 1.7%, which, if I got my numbers right, is the lowest since, well, I think the second quarter of 2020. So, I mean, is that not a kind of figure that the Fed ought to be thinking about? Well, look, perhaps inflation really isn't quite the problem that some of the people in financial markets think it is, or is that missing the point?
Well, I think what they have to do is get to the, this is one quarter's data. They really need to see more than one quarter's data
Right.
to be convinced that inflation is sustainably moving in the direction they want it to and getting back to the 2% target.
All right, fair enough. That's the employment report. What else do you think people should be looking at trying to call Fed policy before we actually get to the meeting itself? What, 20th September, isn't that?
Well, I think there are some downside risks going into this report in terms of there's some large strikes going on in the US. Historically, the August data comes in below consensus pretty consistently and then is subsequently revised higher. August is a tough month to survey because people are on vacation. This year we have a fairly early survey period, so they may not capture all the data they need to compile the report. Well, they'll get the data they need to compile the report, but it may be an incomplete picture.
All right.
So there's room for some surprises in Friday's data. But overall, I think the Fed's going to see that the labor market continues to move in the direction they want to. They're going to see a continued improvement in the imbalance of labor supply and demand. They're going to see that people are still getting wage increases, but not enough to maybe be too much of a factor in the inflation outlook.
All right, then, get down to the bottom line, I guess. I think our consensus, Econoday's consensus, is 170,000 increase you mentioned on payrolls. Your call, from what you're saying, I assume, is that you don't think the Fed will do anything next month?
Ooh, it is a tough call. In reading over Chair Powell's remarks at the Jackson Hole briefing last week, I think that even with the cooling in the labor market, which they will be very glad to see, if we get an above expectations consumer price index report, we could see a rate hike in September. Right now, I think we probably won't, but I'd put it more 60-40 than I would express a high level of confidence in that.
Okay, fair enough. And I guess the last question I'll ask you, just relating to the same sort of thing, is that almost regardless of whether we do see rates go up or they don't go up come September, when do you think we might see the earliest cut in rates? I mean, do you think it's a case we're going to be at or around current levels for well into 2024, or do you think there's a chance we might actually see the first ease come through, say, in the first half of the year?
I don't think we'll see it in the first half of the year, but I wouldn't entirely rule it out. Again, it's going to all depend on what the inflation data is doing. But it's looking like, the room for improvement is getting smaller and smaller. So it's probably a longer slog to get back to 2% than we'd hoped. But I think mid-2024 might be a reasonable estimate.
Okay, fair enough. Anything else from your side?
No, I mean, we're just focused on the labor market data right now.
Yeah. Okay, I bet you are. Great. Well, thanks a lot for that, Terry. I know you're busy, so I'll let you go. And right, for me then, let's move on to Europe and what's going on here. Well, as I say, Terry was talking about the employment report and obviously its implications for inflation. Well, here is very much, as far as the Eurozone in central banks concerned, inflation is the bottom line dominating policy, as it has been for some considerable while. I think many thought the central bank was too slow to respond to accelerating prices and has subsequently struggled to catch up. But it should be said that as a result of some pretty soft real economy data over the last few weeks, financial markets are now pricing in only about a 50% chance or so of an interest rate hike once we get to their meeting. That'll be on the 14th of September. And to that end, what happens tomorrow on Thursday in the shape of the August flash HICP, the harmonized index of consumer prices, will very much set the tone ahead of the meeting itself. Currently, lead inflation in the Eurozone stands at, where are we, 5.3%. The good news there is that's half the rate we had when it peaked at 10.6% last October, since when in fact it's fallen every month until at least now anyway. That said, of course, 5.3% is still more than double the 2% target. The start of this week, expectations for tomorrow are for another drop from 5.3% on the headline down to 5.1%, and that would match its lowest reading since December 2021. However, as we talked about so often on the podcast, it's the underlying picture which is really worrying the central bank and the governing council members at the moment. Now then, more importantly then, that the narrow core rate, that excludes food and energy and some other of the more volatile items, that still stood at 5.5% in July, just a couple of ticks short of the record high we saw in March. So in other words, progress here has been, well, marginal at best. The August expectation for the markets as we currently record this is for a drop down to 5.3%. So moving in the right direction, but clearly still a long way to go to get anywhere close to the target. If that call is right, then I suspect that the fall in itself won't be steep enough to prevent another 25 basis point hike once we get to the 14th of September. In terms of what to look at, simply apart from the core indices, which are very much the driving force for central bank policy at the moment, what's going on in services. The central bank has made a number of comments to the effect that because the relative strength of demand for services, that's been supporting service sector prices as we've recovered from the pandemic, and we still have some additional funds available to the consumer sector which are being spent at the moment, and that certainly seems to have helped to support service sector inflation. Indeed, looking at the overall breakdown, so-called non-energy industrial goods inflation is now down at 5.0%. That compares with a peak of 6.8% in February, so that's really come down quite sharply. But as far as services is concerned, the July figure there was 5.6%, and that was up from 5.4% in June, and indeed 4.4% at the end of last year. So stick a straight line through that little lot, and it really suggests that the trend in the service sector, say the key area that the central bank's concentrating upon currently, is in the wrong direction. Earlier today, it's worth mentioning we had the HICP data, national figures out of both Germany and Spain. They're a little bit mixed. From Germany, we had the rate falling to 6.4% from 6.5%, but the core rate for the consumer price index, we don't get a core HICP from the German national data. That was flat at 5.5%, which is not a good sign. In terms of Spain, the HIC inflation rate there, well, that moved up from 2.1% to 2.4%. So as I mentioned, markets expecting a slowdown in both the headline inflation rate and the core inflation rate for the Eurozone as a whole tomorrow. But just on the basis of some of the national figures we have at the moment, if anything, I guess the risk is on the upside. Indeed, the bottom line, I think, is that we're going to have to see a fairly significant fall, not so much in the headline rate itself, or that's where the biggest chance of a drop is, I think, but crucially in these core rates as well. If we can see some of these hawks on the governing council, rescinding their current calls for another 25 basis point hike next month. Very much the case at the moment, but some of the Northern European contingent central banks, the likes of Germany and certainly Austria, would very much like to see another increase in interest rates. Indeed, as far as they're concerned, it seems that they're not evenly convinced that current interest rates are actually restrictive. So I think they'll certainly be pushing for another 25 basis point hike unless we do see some significant downside surprises when we get tomorrow's report out. Okay, then. Well, see, that's pretty all it then for a quick look ahead at what could be decisive data determining what the ECB and the Fed do in September. Data dependency for most central banks means placing extra weight on the labour market and inflation, alongside, of course, all the other data they'll be looking at. But you can indeed find all you need to know about them. And of course, the other key data and events in Econoday's global economic calendar. So please do check it out. On behalf of Terry and me, thanks as ever for listening. And we'll be back with the rest of the team to update the global economic picture soon. So please do join us then. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.